Hello and welcome to the Strategy of the Week tutorial for April 5th, 2013. My name is Steve Chappell, the Director of Educational Services here at VectorVest. Well, after a significant down week this week, and with a lot of our indicators moving sharply lower on a week-over-week basis, we feel now it's time to tackle a very important subject. So the title of our presentation is Protecting Profits. Many of you are probably sitting on some significant gains on stock positions that you've been trading since the latter part of 2012. One of the worst things that we can do as investors is sit idly by and watch a lot of those profits deteriorate and erode away. So this week we're going to share with you 8 ideas on ways that you can protect the profits that you do have. So let's jump right into the first selection. The first and most common is to use protective stop loss orders. And of course these can be things like percentage gains or losses and many other different methodologies. Dr. DiLiddo discusses this subject in Chapter 10 of his book, Stock Strategies and Common Sense. One idea there is technically oriented investors may prefer to use their choice of a moving average to help them decide when to sell a stock. So let's take a very familiar stock that we've been trading in our surefire success trading systems as of late, Boston Scientific. It's had a terrific run. And one of the things that we can do is we can use a moving average as a guide on when to collect profits on this astounding run. Let's jump in VectorVest and take a look. So here we are at the home page. I'm going to go right up to the top to the Portfolios tab. And while the stock is found in many of our trading systems, if I look at Doug's Downers in S&P, in here it has its largest gain. It's up nearly 40% at 38.15%. While this trading system is rules bound and we're not going to exit out of this position until it either goes up 50 or down 10%, doesn't mean you have to do that. In order to plot a moving average against Boston Scientific, it's as easy as right-clicking on this stock and going to View Stock Graph. By default, it's going to put our VectorVest arrangement on the screen for you. One of the components of that arrangement or layout is a 40-day simple moving average, and it is a great basis or starting point to begin with. This is one that works well with most stocks, and it's a little faster than the 50-day moving average that a lot of the institutions would use. So there's nothing wrong with using the one that right here out of the box. However, some schools of thought teach you that you should customize your moving average to an individual stock and what it's telling you. And what they mean by that is we can lengthen this moving average out to accommodate some more of these fluctuations and what's known as whipsaws in the technical community, where a price goes below and then above and then below and then above the moving average on a continual basis. To do that, I'll just pull out the panel, and you simply come down to your moving average, and in this case we would lengthen it out to eliminate more of those. And it just so happens that we're going to be stopping right about the 48 to 50 mark. Interesting enough, that's what a lot of the institutions would be looking at, and perhaps why the stock reacts significantly around this moving average. For example, you can see that this is the support that this stock Boston Scientific bounced up from most recently. So somewhere between that 40 and 50-day moving average looks to be a good solution for Boston Scientific. Nice thing about this stop is as the price continues to tread higher, this moving average is going to continue to move higher with it, locking in higher and higher prices each day. It is true that if the turnaround is slow enough, the moving average will begin to turn as well. So use this as a good guide. The hope is to capture as much profit as you can and have a mechanical way to do it. Let's jump right back in and look at the next protective stop measure that we could use. Another thing we could do is sell covered calls. You know, this is a great way, particularly for more inexperienced option traders, to get into the option arena. There's very little you can do wrong with a covered call option trade, because at minimum you're going to collect a premium and you're going to keep it and put it in your pocket. And so we explain it here by saying When you sell a call option while owning a stock, you are writing a covered call. If the stock price rises, you may be forced to sell the stock at the strike price you selected, and that's known as being called away. If the stock price continues to drop, you can sell calls against the stock position over and over again, and so your losses on the stock position will be at least partially offset by all the premiums you put in your pocket. So each time you sell the call option, you collect what's known as a premium. And so let's say it has a $2 premium. Each contract you sell controls 100 shares. So if you did 10 contracts at 100 shares at $2, that give you $2,000 infusion of cash into your portfolio, and is going to give you that $2 worth of cushion on the stock position that you currently own. It's a great little trade. Many people shy away from call options because they're afraid that they're going to have to give up their stock. Well, we actually consider that a win because you get the cash infusion, plus you get any price appreciation of the stock up to that strike price. So we'd like to dispel that myth that getting called away is a bad situation. That's the most you can make in this particular trade, and you got that cash infusion, and all signs are actually positive in that case. If for some reason, maybe it's a stock that you own at $4 cost basis and it's now 50 or 60 bucks, I could see where you'd want to hang on to that stock. There's other things that you could do. You could buy the call back and so forth. Now, because of all these different things, I'd encourage you to come to our options course. You know, we teach covered call options as one of our retirement strategies, and boy, we've got a great way to use them to make money year in and year out, called the payday portfolio. The third thing we can do is buy put options. If you own a stock, you profit when the stock price rises. If you own a put option, you profit if the stock price drops. So, if you buy a put option while also owning the stock, you are basically buying an insurance policy. If the stock drops, the put will rise in value, offsetting some of your losses on the stock. If the stock rises, the put will decrease in value, perhaps expiring worthless, just like an insurance policy is designed to do. Of course, you must take money out of your pocket to pay the premium for the insurance. And so there's the rub. A lot of people are adverse to the put option because it's expensive, and they are. Puts are typically more expensive because they're widely used for insurance. And so instead of collecting the $2 premium, in this case you'd have to pay that $2 premium, or a lot of times even higher, say $3 or $4, to insure the underlying asset. But it does protect you against a catastrophic loss in that stock, and peace of mind is worth something. If I continue on, our fourth method is to combine the prior two methods. That's known as an option collar. This is another situation that we teach quite often at our options course, and Dan Mish, the Director of Retirement Services, did a wonderful illustration on this subject on February 22nd at VectorVest University, so you could watch that strategy of the week. And in that strategy of the week, he also did a collar on the index and showed you the equation for how many contracts that you want to buy and so forth to make sure that you've adequately covered your portfolio. It's wonderful. I'd encourage you to see it. It's a terrific way to finance your insurance policy when you combine those two methods together. This is more commonly known as a collar option. We outlined this technique in some detail on March 21st, 2003, and several other times, more recently on July 12th, 2009, again February this past year at VectorVest University. Time after time we've shown it. What you do is when you sell the call, you collect that premium, and that's going to offset the purchase of the put option that you have to make. It's going to offset at least some of that cost. So if you collect $2 from the call and you got to pay $3 for a put, you've offset the cost by 66% of that normal insurance cost. Beautiful trade. This is what the big money managers do. Option 5 is just to buy index put options. You know, very difficult thing to do, just to buy put options on all your different individual positions. So one thing to consider is use a broad-based index. It says here, if you own many stocks in your portfolio from a particular market segment, such as the NASDAQ, you could buy 4Q put options on the index instead of each individual stock. If the index drops, the put options will decrease in value as the prices of the stocks are dropping. This is the same idea as method 3 above, but you would use the index put options instead of the individual puts on each stock. So one trade to offset all the risk on that portfolio, and this will further reduce the cost of the insurance if you're not willing to do the collar option. Our next thing is to buy contra ETFs. I'm happy to report that it seems contra ETFs are becoming more and more popular, and I love that because it's relatively easy to do and it can be done in a retirement account. It says here we have several searches located in ETFs folder in Unisearch, which will guide you to the funds best poised to profit when the market contracts. If you want to avoid the leveraged funds, you can choose from the non-leveraged ETFs contra watch list and only look at funds with a 1-to-1 ratio. So let's jump into VectorVest and explore this a bit. Let's start in Unisearch. I'm going to go right up to the top, click on the Unisearch tab. Over on the left we have an ETFs folder. In this folder there are 3 main searches I'd key in on. My favorite being the most recent one that we put together, called Index ETFs Contra. If we run the search as of 2:53 p.m. today, for example, it's going to pull up a small selection of contra ETFs to pick from. And the reason it picks a small basket, we're looking for some momentum with these positions. We're looking for a 5-day moving average to have crossed above a 10. Contra ETFs move inverse to the market. So when the market is falling, you actually buy these long like you would buy an ordinary stock. And as the market continues to fall, these contra funds are like mutual funds that short the market for you. The fund value actually rises because they're shorting, and hence the name contra or inverse. One thing to certainly point out, now this search has a requirement of at least 100,000 average volume. There are many contra ETFs out there that are more thin than others as far as liquidity is concerned. So one significant thing to look at is the volume on these positions. Oftentimes the company name is quite descriptive, so this is an ultra short. I just know by that terminology that this is going to be a leveraged fund. Let's discuss that just a bit. One way to know for sure is to right click and go to View Full Stock Analysis. In the stock analysis report, in the business description, will give you all you need to know about these contras. Important for several reasons. You want to make sure when you're new with contra ETFs that you're using broad-based, broad market indicators like Russell, NASDAQ, S&P. Don't get caught in getting into a contra fund on something like gold or natural gas or the VIX or something like that that doesn't necessarily have to move directly inverse to the market. Here it says this investment seeks the daily investment results that correspond to 2 times the inverse or daily performance of the Russell 2000. So this is a 2-to-1 ratio. Also, if you're brand new to inverse funds, you may want to stick with more of the 1-to-1s, and I'm going to show you how to find those in just a bit. But a lot of the liquidity, of course, because investors are greedy these days, is being pushed into the leveraged funds. That's where most of the money is pouring into. If I close this out, there are some other options here. You have worst performing contra ETFs and buying contra ETFs. All of them are good. Another place that you can go to find contra funds is in watch lists. So if I go up to viewers at the top, we have an ETFs watch list folder, and in here I want to discuss a couple different ones. We have a list of just contra ETFs. This is all contra ETFs, the entire universe. So we've got 114 items in there. If I scroll down just a bit, we'll have a leveraged contra, so it eliminates the 1-to-1s, and we have a non-leveraged contra. This is where people who are brand new to contra ETFs may want to begin, is with the non-leveraged. But again, you want to go through that exercise. I suggest looking at the volumes. You can see some of these are quite thin, and if you sort by average volume, not a bad way to go. It'll push the most liquid ones to the top, and you're going to see that a lot of those are going to have to do with like the S&P 500, the NASDAQ, and so forth. But be careful, there can still be some VIX and other things mixed in. So again, pull up those stock analysis reports, read the descriptions, stick to broad-based, broad market contra ETFs. RWM for the Russell. PSQ is not a bad one for the NASDAQ. And let's just scroll out to the right. We've got some nice liquidity with those. SH, not a bad option for the S&P 500, and so forth. Let's jump right back into our PowerPoint. So the next thing that we can do is hedge with short sales. Another way to protect profits in an uncertain market is to sell short bad stocks while continuing to hold your long positions in good stocks. For example, you might use the search as short group in VectorVest to find stocks that are likely to go down and sell them short. If the market falls, these shorts will rise in value while offsetting the losses you might incur in your core holdings. And so you've seen a lot of evidence of this in our surefire trading systems. We have found that this is a great way to go. When the market gets toppy and begins to start turning over, you'll notice that we begin to pick up short positions or contra ETFs in those cases, depending on which trading system you follow. And those positions stay in there until, of course, they hit their gain or their loss. And so they provide that beautiful natural hedge. The last thing that we can do, of course, is just sell your stocks outright. The surest way to protect your unrealized profits is to simply sell the stocks you own. You then simply hold cash in your account while waiting for the market to settle down. Of course, once the stocks are sold, you would not participate in any further upside price moves. Also, unless you're selling the stock in some sort of tax-advantaged account, such as an IRA, Keogh, there's a lot of different ones, you will owe tax on your capital gains. So there's always considerations that surround each of these topics. But you must do something to preserve the profits that you currently have. While it looks like we may be buying the dips yet again today, who knows? It could turn out that that's not the case and the market collapses just like we saw before back in 2008, 2009. And if that ever materializes again, you're going to be glad that you've taken some of these steps. Even if the market comes off 10, 20% from where we are now. Protective stops ensure that you're profitable, and that's why we enter into the stock market anyway, isn't it? To be profitable. Listen, thanks for spending this time with us. We believe this to be a timely message for you this evening, and we'll see you next week at VectorVest University.